Are you literally losing sleep over IND AS 19? Look, if you're an accounting student, post-employment benefits can feel completely overwhelming. The calculations, those complex actuarial assumptions, the endless accounting treatments, it's a lot to process, right? But honestly, don't worry. Welcome to this explainer. Today, we're going to do a very simple tactical exam revision to clear up all that confusion once and for all.
Welcome to the IND AS 19 Employee Benefits Exam Masterclass. Once you actually get the underlying logic, this is a highly scoring topic in your exams. So let's just set aside all that heavy textbook jargon today and focus purely on clear, simple concepts.
Here's our agenda for today. First, employee benefits basics. Second, defined contribution versus benefit. Third, understanding plan risks. Fourth, recognition and measurement criteria. Fifth, other and termination benefits. And finally, a quick final exam review.
All right, let's jump straight into Section 1, Employee Benefits Basics.
So the standard basically divides employee compensation into four main pillars. First up, we have short-term benefits, like your regular wages or paid leave. Second is post-employment benefits, like pensions. Third, we've got other long-term benefits. Think Jubilee leaves. And fourth, termination benefits. Basically, every single employee benefit you can think of is going to fall into one of these four buckets.
Now, the absolute crucial boundary to remember here is 12 months. If a benefit is expected to be settled wholly within 12 months after the annual reporting period, it's short-term. But the moment it crosses that 12-month mark, it becomes long-term. And guys, that is exactly when the accounting gets complex, because that's when discounting comes into play. Moving right along to Section 2, Defined Contribution versus Defined Benefit.
For the exams, you absolutely must be able to contrast these two. In a defined contribution plan, the company simply pays a fixed amount into a fund. And that's it. Once paid, the employer's obligation ends completely. They've done their part. But in a defined benefit plan, the employer promises a specific future payout when the employee retires. So here, the employer's obligation simply doesn't end until that final promised amount is fully paid out.
Which brings us nicely to Section 3, Understanding Plan Risks.
So who pays when you're extra hungry? Think of a defined contribution plan like an employer giving an employee exactly 500 rupees for lunch. If the restaurant suddenly raises its prices, or hey, maybe the employee is just extra hungry, the employee bears the risk. The employer only promised those 500 rupees, right? A defined benefit plan, however, is like the employer promising an unlimited lunch buffet. No matter how much the employee eats or how much the food costs tomorrow, the employer has to foot the bill. Now let's solidify the actual academic definitions you'll need. Actuarial risk is basically the risk that benefits will cost more than expected. Like, what if employees live much longer than we anticipated? Then there's investment risk, which is the risk that the invested assets will underperform. Please remember this golden rule. In a defined benefit plan, the employer bears both actuarial and investment risks. In a defined contribution plan, those risks fall entirely on the poor employee. All right, let's tackle Section 4, Recognition and Measurement Criteria.
Honestly, for defined contribution plans, the accounting is such a relief. Because the obligation is just a fixed payment, you don't need any complex actuarial assumptions. You simply recognize the contribution payable as an accrued expense. Paid extra? Simple. It's a prepaid asset. It really is that straightforward.
But defined benefit accounting? That's complex, mainly because the future is so uncertain. The standard mandates 4 highly testable steps here. Step 1, you determine the deficit or surplus using actuarial techniques. Step 2, adjust for any asset ceiling limits. Step 3, calculate the exact amounts for the profit and loss statement. And Step 4, determine the remeasurements for other comprehensive income. Now, for that first step, you absolutely must use the projected unit credit method. Make sure you memorize this name. Think of it very simply. Every extra year an employee works adds exactly one specific unit of benefit. This method measures each unit separately to build up the final total obligation. And remember, it's literally the only method allowed by the standard for defined benefit plans. Okay, so once we project the future payout, we have to discount it to present value. But what discount rate do we use? Please listen carefully, as this is a super common exam question. The standard requires you to use market yields on government bonds at the end of the reporting period. However, and this is a big however, If there's a deep market in high-quality corporate bonds for a specific currency, you must use those corporate bond yields instead. Don't forget this distinction.
Next, let's categorize these defined benefit costs. Current service cost and net interest, those go straight to your profit and loss account. But remeasurements, things like actuarial gains and losses or the actual return on plan assets, they bypass P&L entirely. They have to be recognized in other comprehensive income. And please remember, they are never, ever reclassified to P&L in subsequent periods. Moving on to Section 5, Other and Termination Benefits. You really need to know the strict difference here for the exams. Termination benefits arise strictly from the company's decision to end employment early, or maybe an employee accepting an offer for voluntary redundancy. They are absolutely not earned over years of service like a pension is. So keep this in mind. Termination benefits are purely an event-driven expense.
Now what about multi-employer plans? Usually, you just classify them based on their actual terms. But here's the classic exam trick. If you lack sufficient information to reliably measure the obligation among the participating employers, the standard actually allows you to account for it as a defined contribution plan, provided you make the specific required disclosures.
And finally, Section 6, our final exam review. Let's lock in the most heavily weighted difference you'll see on the paper. In defined contribution, the obligation is fixed, the employee bears the risk, and the accounting is delightfully simple. But in defined benefit, the obligation is an agreed future payout, the employer takes on the risk, and the accounting requires some pretty complex actuarial math. I want to leave you with a quick conceptual check, straight out of the standard. If a company sets up a plan where they pay fixed contributions, but they also guarantee a specified return on those contributions, what kind of plan is it? Think about the risk for a second. Because of that guarantee, the employer is bearing the investment risk, right? Therefore, it's a defined benefit plan. Seriously, don't let the word contributions trick you on exam day. Always follow the risk.
And that brings our masterclass on IND AS 19 to a close. But before you go, ask yourself this. As the global business landscape changes, do you think complex defined benefit plans will eventually go extinct entirely? It's definitely something to think about. If this structured explainer boosted your confidence today, please like, share, and subscribe for more. Keep revising those fundas, and you're going to do great. Thank you so much for learning with us.